keep in mind, this is a story that's been many years kind of on the come. They've been in a very heavy investment cycle for, 5 or 6 years now. And every year was kind of a bit of a false start on street expectations as to when this thing would inflect. I think we are kind of finally here, and I think that's important because the whole profile of this group right now remains that, at least a couple months ago when I talked to you guys, was that the defensive growth names were getting very high multiples, and the cyclicals were getting very low multiples, and people were very nervous about those. And I think you've seen that reverse a little bit here in the last, obviously, month or so, which I have my views on. But UTX is one of those where it should really be in more of the defensive growth camp, and it was trading like it was a beaten down cyclical, and quite frankly, with the 6% free cash flow yield going higher, actually, remains that way. So what we like about it is, with the visibility of this portfolio and the long cycle nature of the businesses and kind of this inflection in free cash flow, this is one where, given the bounce in some of these more beaten down cyclicals, you can actually buy visibility and growth at a really cheap multiple, and you don't have to worry about this kind of prevailing sentiment trade, which can change with each ISM print.
It's interesting. Josh was making the point a few moments ago that you can wait for the breakout if it floats your boat, but it's coming, and maybe you're suggesting as well that you can get ahead of this rather than wait for it because there's this compelling enough story to do that.
Yeah, and there's not that many stocks out there. The visible growth stocks are expensive, and now actually, when you look at these cyclicals and the moves they've had, a cyclical name like Rockwell in my group is already trading at 20 times earnings, 14 times EBITDA. These cyclicals are now, quite frankly, expensive. So this is, in my view, one of the best of both world stocks. And again, what I think long-onlys should like about it, and people who are looking longer term, is that this really is much more about kind of a 5 to 6 year investment cycle now coming to fruition. And when you get these long cycle investment cycles right, these turns can take many years, almost decades, to play out, and that's really where we think this company is, especially with their geared turbofan on the aviation, on the aerospace side.
Hey, Steve, do you think UTX specifically, and then other names in the industrial space in general, benefit from money coming out of Boeing and GE and companies like that? Like, are there other areas that you would look at as candidates for a rotation within these sectors?
Yeah, so our favorite pair has been over the last, since we reinitiated on UTX this spring, was long UTX and short GE. Because when I look to these two engine businesses, again, GE has really cleaned up over the last several decades based on their dominance of the narrow body market. They now own close to 65% of departures globally. In our view, that's a market share that can do nothing but really go down from here. And we believe the UTX geared turbofan technology is ultimately a better technology, and that they are the share gainer over the next, call it, 1 to 2 decades. And by the way, very minimal exposure to the MAX with these guys, really only in their UTAS business. That's a sole sourced GE engine. So, on several fronts, we think this aviation business at UTX is better positioned than GE's, and you're getting it for a 6 and change % free cash flow yield versus GE on our numbers is trading obviously a lot more expensive than that. So I think this is one company that can certainly benefit from any money that comes out of those guys, and then obviously Honeywell is another we've liked for a long time. That's a little different story. Plenty of capital to deploy, a bit more on their front foot as a defensive growth stock, and a little bit more expensive, but still the balance sheet differentiates there. And when they deploy their capital, I think that's the next kind of catalyst for that guy.
Yeah, you and our Joe Terranova, who has a question for you in just a second on Honeywell. He likes it as well. But let me ask you one more on UTX before we move on. What do you make of the carrier softness and the Otis strength? How do we square that? What are we to think about that?
Yeah, so I think first of all on Carrier, as we've said before, with a diversified industrial, every rose has its thorn, to quote Brett Michaels. But this one in particular is Carrier, and I think that there's a cyclical and secular element to this. The cyclical part is their truck refrigeration business, which is down significantly and totally understandable, and we think bounces back pretty hard at some point in the second half of next year. On the more secular side, we do think that the residential business probably has, it requires a bit more investment, perhaps some distribution channel restructuring, and that is an issue. That being said, their Carrier business is trading at an implied multiple of less than 10 times EBITDA, which is a 15 to 20% discount to most of the peers out there. So I think that in the sum of the parts, that risk is fully discounted and not something that worries us. From an overall stock perspective. And Otis, which is a higher multiple business, deserves something in the range of 14 to 15 times EBITDA, is hitting bottom and now turning for the next couple of years, very similar to kind of the aerospace story. So on net, still very positive on both commercial businesses.
Yeah, we got the HOD on UTX. That's the high of the day. Joe, what do you got for Steve?
Steve, I think you would agree it's been very challenging to find industrial opportunities over the last 18 months. For me, it's been odd names. It's been Cintas, it's been Copart, it's been Masco, and yes, it's been Honeywell. Do you think a report like we've gotten today from UTX opens the eyes of industrial portfolio managers, and there's a name looming out there that's going to report on Thursday that has been awful, and you know what it is? It's 3M. Is there any possibility 3M, a $100 billion company, gives the type of performance we're seeing here from UTX?
So keep in mind, again, as a long cycle portfolio that, really grows off of its backlog, UTX is definitely not the best indicator for the kind of real-time, short-cycle industrial economy. So a bit of a different story, even though it's kind of a diversified mega cap. 3M is much more short-cycle in nature. We remain negative on 3M here. It's had a nice little bounce. I think that you're going to continue to see sluggish trends, that there's probably downside to the numbers. And I think there are, stocks that are a little more, levered to the industrial economy that are going to probably react a little bit better to moderate weakness. So I don't think 3M is going to be a disaster, especially in the context of what they put up in the first quarter, but I still see a downside bias to numbers, and it's not cyclical enough to get re-rated like, for example, a Rockwell or a Caterpillar might on weaker results. So, and they also have the overhang of this PFAS liability that I think is keeping some long-term investors on the sidelines, even though the numbers have come down a decent amount. So that's 3M is a bit of a special sit because of that overhang on the liability side.
Steve, I've got as good and well-studied portfolio manager as you'll find in front of me today. Stephanie Link of TIA has been buying this stock. She's been adding to it, GE. She believes in that story long term. You reiterated the $5 price target recently. When do you think that story turns around? What do you tell somebody like Stephanie Link, who's done the work, who believes this story is going to work in the long run and is willing to wait?
Yeah, I really I have great admiration for Stephanie and the people over there. The bottom line to me has always been, what's the free cash flow trajectory for the next couple of years? And I think that over the next several months, we're going to get much more visibility on what I consider to be the bridge year, which is, 2020. And ultimately, I don't see an inflection here in the next couple of years on both fronts. So, I think we put out a decent amount of work on our views on the various businesses, and I just don't see the free cash inflection, especially in the context and in light of what's going on in aerospace, even outside the MAX. I think that franchise is significantly closer to a peak than a growth trough. And so that's, part of the differentiated thesis that I think people are going to probably start to learn about over the next 3 to 6 months, which as a dramatic cornerstone of value for this company needs to, be looked at a bit more closely to validate what I think is a optimistic bull case on, growth there for the next couple of years.
Steph? You have something for Steve?
Well, hi, Steve. How are you?
Good.
So I understand on aerospace. What about power gen? I mean, I know that that's been the real problem for the company. Do you think that there is a bull case to be made on that part of their business? Or is it just maybe it gets less bad? And is that good enough for the stock, do you think?
Yeah, I don't think I think power gen is, first of all, we are going to deliver gas turbines. The gas turbine business is not, there's not going to be zero gas turbine delivery. So I've never really kind of, made that call. What I will say though is, if you believe that renewables will continue to take market share and the levelized cost of energy curve will continue to move lower, then the longer term, cannot be positive for centralized generation and gas turbines. And I understand that there was perceived to be a little bit of a better of a result at that business in the second quarter. First of all, they resegmented the businesses, so it's unclear how good that quarter actually was. We don't even have restated financials going back a year on this business. And secondly, I'd like to see them put up profits when they actually deliver turbines. They've delivered one of their marquee H-frame turbines year to date out of their forecast of 13. Each turbine is significantly loss leading. So I just don't think it's appropriate to say a business is turned when they're, one of the ways they're doing this is not delivering any product. That's not sustainable. I've never run a real business before, but I think you actually have to deliver products to put up profits and revenues over the long term. So I think the power remains a big TBD, and ultimately longer-term levelized with cost of energy forces price down for their products, which means time will not heal all wounds here, and we remain pretty negative on that gas turbine franchise.
Good for our viewers to hear from you today, Steve. We appreciate your time very much. We'll talk to you again soon.
Yeah, thanks a lot, guys.
All right.
Take it easy.
Yep.